and welcome to this very special pre-budget edition of the Money Show, where India approaches the union budget at a moment of relative macro strength. Domestic growth remains robust, inflation is under control, and government finances are on a consolidation path. Now, equity markets under the wrap of geopolitics, corporate balance sheets improving at a slower pace, and India continues to be seen as a long-term structural growth story. Yet, this budget is being framed against a far more uncertain global backdrop. Geopolitical conflicts, supply chain disruptions, rising trade barriers, and uneven global growth continue to pose risk. Global financial conditions remain tight. Volatility in capital flows cannot be ruled out. Against this backdrop, the expectations from the budget are high and varied. For individual taxpayers, the focus is on simplification and relief. Will the government finally settle the debate between the old and the new tax regimes, rationalize deductions, and improve ease of compliance for markets and investors? The key questions revolve around fiscal discipline, government borrowing, and capital expenditure priorities. Can the government continue to reduce the fiscal deficit while sustaining growth? Will capex remain a key pillar, and which sectors will benefit the most? And at a structural level, the budget has an opportunity to look beyond the near term to address job creation, boost innovation, research, strengthen domestic manufacturing, and also raise productivity across agriculture and services. Now, to decode what this budget could mean for taxpayers, investors, and the economy at large, I'm joined by a distinguished panel. I have with me Kinjal Bhuta, CA and advocate, Mahendra Jaju, Executive Director at Quant Mutual Fund, and Rajni Sinha, Chief Economist at Carriage Group. I'm Kavita Thapliyal, so all you have to do, viewers, is stay with us as we break down the numbers, the policy signals, and the real impact of Budget 2026. Hi, good evening, and welcome all of you to this very special edition of the Money Show. Rajni, I'll come to you first because we need to focus on the bigger picture. The first thing, the budget comes at a time of strong domestic growth, but global uncertainty. Definitely, that's a question mark. Should the government prioritize stability or use this moment for bold structural reforms? How are you looking at it?
Kavita, you very aptly highlighted that while the domestic parameters in terms of growth, inflation, they are looking good, but at the same time, we are in midst of heightened geopolitical conflicts and global uncertainty. And it's not just a story of 2025, but it's likely to continue in 2026 and beyond. So this is the time, like Eco Survey highlighted, this is the time when the government should look at proactive strategies and not defensive mechanism. So what I mean by proactive strategy is that now the government should look at what are some of the structural reforms that can help India in maintaining high growth over a longer period of time. So in terms of, quick solutions, few things have happened in the last few years in terms of income tax rationalization and also some other structural reforms like FDI liberalization has happened, labor reforms have happened. But this is the time when the budget should now look at some of the bigger aspects. For example, one thing I would like to highlight is, say, R&D. I think now is the time India should start focusing in a big way on research and development. Right now, the expenditure on research and development in India is pretty low at around 0.7% of GDP, as against 2.5 to 3% for innovation-led economies. So, if we are going to looking at moving up the value chain and we're looking at a sustained high growth of over a longer period of time, then we should increase our focus on research, development, and innovation because we have talent. It's just that we need to incentivize the private sector to go in more for research, development, and innovation. Similarly, this is the time when to focus in a very concerted way as to how the employment situation can improve in the economy. Because only when the household income increases will we see consumption improving and investment and other parameters improving. And given that global demand is going to remain weak going forward, it's the apt time to focus on domestic demand and what are the structural reforms required to improve domestic demand. And here, increase in household income and employment generation would be a very important aspect. Similarly, very briefly, I would touch upon the aspect that they should also look at reforms in the agriculture sector, because only then can we ensure an inclusive growth in the economy.
All right, so a proactive strategy is needed. We'll take all of these steps one by one. But coming to you, Mr. Jaju, India is committed to fiscal consolidation. But should the focus shift from annual fiscal deficit numbers to total understanding government debt, Mr. Jaju?
Yeah, so government has already announced its intention to shift from, the fiscal deficit as a percentage of the GDP to total outstanding debt. Now we know that over the last, you know, few months, especially, there has been a lot of talk about how some of the developed market economies like Japan or US, their debt to GDP is now more than 100%, and therefore there is a concern on refinancing, etc. So I think our government has set a very clear path in terms of fiscal consolidation. So the government has indicated that from the current levels of 56% of the GDP debt outstanding levels over the next 5 years, the government will want to bring it down to around 50% plus minus 1%. So the glide path that the government has indicated is reduction in the outstanding debt to GDP by about 1% every year for the next 5 years. Now, if we do the numbers and bit of a math, if I assume a nominal GDP growth of about 10% for FY27, which is quite likely because the economic survey has projected a GDP growth of somewhere around 7.5%. And then if I take the inflation to be at about 2.5%, or if we take the deflator, so to say, to be somewhere in that region, then the government can look at borrowing at approximately about 4.3 to 4.4% of the GDP as incremental borrowings in the next year. So for the current year, therefore, there is no major friction or disruption when you switch from the method of borrowing by way of a percentage of GDP to percentage outstanding debt target. Now, that is a very, very significant move, because this is, I think, one of the most significant structural fiscal consolidation measure that we as a country are going to take, because all of us remember FRBM, 1 year back and 10 year back, and there were different targets set, but those could not be met because of the exigencies that arose because of the external situations. In some cases, for example, COVID happened. Now, that kind of a structural move can have a difficulty because of the numbers involved, but in this case, I think it's going to be a smooth transition. Sorry, so I don't see a major friction. The other part is that the government will have to deal with a little bit of a higher gross borrowing this year, because the maturities or redemptions in the next year is going to be much higher than in the current year. But that's a subject which is not exactly related to this. But I think all in all, the shift from the old method to the new method is a very, very significant structural move that the government has taken.
Talk about tax, and Kinjal, the government has been nudging taxpayers towards the new tax regime. You must be having some data on it also. What's the percentage of onboarding? Are we talking about 90+%? And is it time to finally abolish the old tax regime altogether and move to a simplified system?
Absolutely, Kavita. So the onboarding experience with the new regime has been quite positive.
Sure.
There have been a lot of people who have onboarded to the new tax regime, and barring a certain few who had a higher deduction or higher income tax slab rate, which is to be enjoyed, especially senior citizens. I think it has been almost an 85 to 90% who have onboarded onto the new tax regime. I think it is the right time and a good expectation to have from this particular budget, though a bold movement, but it is required that the old tax regime is completely abolished. as we see that in the past 1.5 years after the advent of the new tax regime, there have been a lot of complications which is incurred because of the old and the new tax regime, and there have been a lot of confusion in the personal taxpayers. So I think it's while the move was very much required to have a level playing field and to not abruptly bring a new tax regime.
I'll come to you, Mr. Jaju, because we have to really focus on jobs and demographics. The same question can be answered by Rajni also. I'll take a take with her from her. But then, Mr. Jaju, nearly 46% of India's workforce is still in agriculture. Now, is this a sign of demographic strength or disguised unemployment? Should the government take a few high employment sectors like electronics, pharma, autos, textile, and build global scale clusters around them? Is this the time for it now?
So the divide between the agricultural sector and the urban, or so called the modern industrial architecture in terms of labor, is a part also of the history. The way in which our country has evolved. We started with a 75% workforce in agriculture, and then there has been rapid urbanization in the last 10 years, especially the road connectivity and the digital penetration that has happened, I think has completely changed the landscape. Therefore, today I think the segregation between rural and urban employment, I think is beginning to sort of converge, although it's a long way off. And as you rightly said, there is an urgent need to deploy carefully the huge uh, uh, the young population, as we know that India is one of the youngest population. I think there has been significant measures which have been taken, PLIs in the last few years. Before that, our economy has been driven by the engine of the government capex. The government capex has largely been in the construction sector, whether it is roads, ports, or uh, other things, and therefore there has been a huge employment generation already. The employment data shows. Now, I think there is a need to do more of the same. There is a slowdown happening in terms of the IT, which has been a very big employer of the uh, white collar people, so to say. So therefore, there is a need to put focus on AI, which is going to give the jobs to the next generation. But I think if you look at the overall, reform process that the government has adopted, including maybe the after in the budget, there is a clear focus on that
Absolutely.
side as well.
Absolutely. Let's take Rajni's view on this also. Rajni, what should be done to build global scale clusters now? And also, since you mentioned in your earlier answer about the innovation gap, India spends just 0.7% of GDP on R&D, far below innovation-led economies. Is under-investment in R&D a structural risk now for a long-term growth? Also, let's put the lens on the private sector, Rajni. Private sector contributes only about 36% of R&D spending in India. Could a research-linked incentive scheme similar to PLI change that?
Yes, Kavita, I agree with the issue that you are highlighting. Research spending in India is only at around 0.7% of GDP. Also, as I mentioned earlier, it's much higher at around 2.5 to 3% for innovation led economies. Moreover, the private contribution to research spending is also low in India at around 36% or so, as against some of the other economies, it's as high as 70%. So definitely the private sector also needs to get pulled into this whole R&D spending and innovation. So, some of the things that the government can do is one, the government should set up some world-class research institutions in the country, just like, some world-class academic institutions that we have, like IIT and AIMS. Similarly, we need that kind of, research institutions. Secondly, the academic institutions that we already have that tie up with those institutions the IITs and aims with with the private sector, with the corporate sector, that should be strengthened. And yes, I feel that the government can look at something like research linked incentive scheme, where the incentive would not just be based on output, but because this whole R&D is a very, is a very risky affair, and sometimes it can be successful, it cannot be successful. So the mechanism should be devised in such a way that this incentive is based not just on output, but also on the resource allocation. So I think that will kind of give the confidence to the private sector to go in more for innovation. Now, talking about first part of your question as to what needs to be done to further push up employment in the economy. Yes, definitely. Like you mentioned, agriculture sector, there is disguised unemployment with around 46% of the workforce there, whereas the sector is adding only around 15% to the GDP. So the easiest step would be firstly to move workers from the farm sector to agri and agri allied sectors like horticulture, floriculture, or agri processing. That would be much easier because that will still be in the rural area, and it will be easier to move people to these sectors. So the government should focus on growth in these sectors because the productivity is higher in these sectors. And secondly, when it comes to manufacturing sector, they can identify some sectors like you mentioned, auto ancillary, electronics, pharma, where there is growth potential, and build a whole ecosystem around it, which is already, it needs to be strengthened, push up investment and employment generation capability.
Absolutely. The, streamline over there is really required. But then again, coming back to personal tax and Kinjal, standard deduction is 75,000 today. Now, with rising cost and inflation, does it make sense to push this closer to 1.25 lakh? Also, other thing, partnership firms continue to be taxed at 30% while corporates enjoy lower rates. Is a cut to 25% overdue to support small businesses, because that is also a major growth engine?
Correct. Absolutely, Kavita. So, what we see is a trend in the last 2, 3 years. There has been a strategic, trend by the government in the budget where we see that they are rationalizing the tax rates. Now, where we see that which are the classes on which the rationalization of tax rates has been made is basically the corporates, which is the companies wherein there has been a different regime which has been started. That was the first one wherein the government brought about the new and the old tax regime. Then it came up with the individual taxpayers. Unfortunately, there has been nothing which has been brought for the partnership firms and LLPs. So that has been one area or one taxpayer, category wherein there have been no change absolutely in the tax rates across so many years. The tax rate remains the highest personal tax rate which we have in the country, which is 30%. Obviously, if you add on the surcharges and education cess, it will go up to 34 approximately. I think a lot had been done in the last budget on the lower middle class, where there was rationalization into the increase of slab rate in tax rates. Now, I think it's high time where we have something for the middle class and the higher middle class, which is where both the issues which you have rightly pointed, the standard deduction as well as the increase, reduction in the tax rates of the partnership firms, both will fall into that category. So while we come at the standard deduction, I think there has been an increase which has been steadily across the years, from ranging from 30,000 to 75,000 now. They've come a long way, but I think the kind of the inflation which is existing and the kind of the standard of living which has been increased, having a reduction of 75,000 just doesn't resonate with the current times. So I think it's high time it is increased to 1.25 lakhs. And also it is very essential because for salaried taxpayers, unlike the business, business holders, you do not have any other expenditure which you can take a debit out of your income, right? The standard deduction is the only amount wherein you can take that spendings, whichever spendings which you have. So I think it's high time to increase that limit, if not 1.25, at least to 1 lakhs. So at least it is in trend with the current timings. And high time also for reduction in the tax rates of partnership firms and LLPs from 30 to 25%. It will bring in line with the corporate taxation as well as the personal taxation. And it will bring a lot of impetus to the higher middle class and the middle class taxpayers.
Absolutely. Last round of questioning, and Rajni, macros are resilient, but global risk remain elevated. Can India afford aggressive fiscal tightening without hurting growth?
Actually, there is no need, Kavita, for
Okay.
aggressive fiscal tightening anymore.
Okay.
Because
Okay.
if, and actually the government, if they are talking about moving to debt to GDP target and giving a trajectory of that, in fact, like we discussed earlier, if we assume nominal GDP growth at 10%, which is quite reasonable. So if we expect that for the next few years, the government can very easily remove the debt, reduce the debt to GDP by 1 percentage point every year for the next few years and reach their target of 50% of GDP by FY31. So this is something very achievable. And if in fact the nominal GDP growth turns out higher, which is also quite possible, then it gives flexibility to the government to go slower on fiscal consolidation. And actually, that's very important because this is the time when, even though the growth is looking good right now, but there are just too many risks on the global front. And those risks are likely to linger. So government should keep these ammunitions ready and provide, because on the monetary front, also they've already given monetary stimulus. Rate cuts have happened. Fiscal stimulus also they've given. Tax rate cuts have also happened. So now, but they should keep these ammunitions ready and not tighten the fiscal balance very tightly, otherwise that will disturb the growth trajectory, and they don't need to do that. Debt will anyways reduce by 1 percentage point for the next few years.
All right.